Definitely. Yeah. So thank you, Heidi. So today we're presenting a discussion on tax planning, tax preparation, trying to save money on income taxes. And we're with Hayes and Associates, and the three of us that are here today is myself, Brad Yoder, Greg Johnson, and Jason Ferris. We're all directors here at Hayes and Associates, and we've been in business for 30 years, and we look to help small businesses and individuals in their tax problem needs. And so, throughout the year, there's times where we, of course, are preparing the tax returns, and then or helping them put together their financial records, and also throughout the year answering their questions in terms of how they need to either structure their business or handle a particular transaction, or just tell them, this is the effect of what you're looking to do possibly. So with that, we are going to go ahead and get started with the handout materials that we provided and go through those, and we're going to touch on a lot of areas about individual taxation and talk about some business tax areas, and we'll make sure to touch on, I don't think there's anything in here for the home office deduction, so we'll make sure to touch on that as well. So in talking about taxes and tax planning, we're going to go to our second slide here, which just a real sarcastic slide here about saying that remember the good old days when taxes were simple. And it's just interesting, when taxes first came around in the United States, at least from a federal level, it happened in 19, and basically, not a lot of people knew how to file their taxes or what they were going to be expected to do, and so it was kind of it was a new thing 100 years ago that the federal government decided, well, we're gonna have an income tax at the federal level, and so everybody had to start complying back then and figure it out. And now we're 100 years later. In our next slide, we've got challenges that remain today, and so we just to overcome those challenges, we need everybody to be informed taxpayers and try to figure out the best way to approach your taxes to limit your liability. But the tax code keeps getting more and more complex, and if you look at the code, today it's over 9,000 pages of code, and then on top of that, if you have even more, just in terms of the discussion of how to do it. So the code's one thing that has that's just the legalese part of it that's in the IRS code. But there's something that even the IRS admits in the Taxpayer Bill of Rights, and that you have the right to pay no more than the correct amount of tax. And so we try to take advantage of that and make sure that you're only paying as much as you are supposed to. Coming up to, again, some more current events, we have the next slide, just a comment that the American Taxpayer Relief Act, that was implemented early in 2013 and made many federal tax provisions permanent, where there were several provisions that were just being extended year to year. And so it was always a challenge from a tax planning perspective to say, okay, well, we believe this is going to get extended, but if it doesn't, then A, B, and C will happen. So you have to try and think about it both ways. But this was helpful because it did at least make several things permanent that had been extended year to year. Some key tax rates for individuals to keep in mind is basically you've got several brackets. The lowest is a 10% bracket, and then a 15% bracket. It jumps to 25%, 25, 28%, 33%, and then the jumps to the 39.6%. I'm sorry, the 35%, then 39.6%. If you're single, the top rate is at $406,750, and then your top tax rate is 35%. And then for married couples, the cutoff point for the 35% bracket is $457,600, and then anything above that goes to the 39.6% bracket. And the long-term gain, there's a different bracket for capital gains, and so for long-term capital gains and qualified dividends, the maximum rate is 20% if you're in the 39% income bracket. And then that capital gain bracket is down at 15% if you fall between the 25% and 35% income tax brackets. And then you can go as low as 0% for your capital gains if you're in the bottom two brackets of 10% and 15%. And then, of course, the long-term, there's a difference between a long-term and a capital gain rate. The short-term capital gain rate is going to be at your ordinary rate if you held that capital asset for more than a year. And in addition to all those brackets that I just talked about, introduced new taxes or tax. Everybody has heard about it. There's Medicare surtax income could apply in 2014. Medicare tax applies to wages and self-employment income if your adjusted gross income is above $200,000 for a single individual or $250,000 for a married filing jointly, and that's at a rate of 0.9%. And then there's a Medicare surtax, which is that net investment income tax of 3.8% if your investment income net investment income if your AGI exceeds $200,000 or $250,000. And so we've been doing a lot of tax planning questions around that area, trying to make sure people are aware of that. And let's see. So that's just some key rates and thoughts for individuals. There's some different brackets than for C corporations. The next area that we have to talk about is about exemptions and deductions. And so from the exemption standpoint, you've got personal exemptions, which are essentially your dependents or individuals that you can claim as a dependent. And those, there was something that was passed where if you're at too high of a tax bracket, those exemptions now get taken away. There was a period of time in the last decade where that wasn't the case, but unfortunately in 2013 it came back, and so that's a big break to individuals that are right there at the kind of at the top end of that higher income brackets of that $200,000 and $250,000 area. Yeah, Greg, go ahead.
This is Greg Johnson. One of the things I wanted to mention, just as we left the last slide, oftentimes you will get questions about what bracket am I in, and one of the questions we get is, am I in the 25% bracket or am I in the 15% bracket? I think it's important to point out how the tax rates and your taxable income actually works. If you're in the 25% bracket, as an example, that does not necessarily mean that all of your income that you receive is going to be taxed at 25%. It's sort of a graduated scale, meaning the amount that's taxable up to the 15% will be taxed at that, or at the 10%, and then at the 10% rate, and then that everything above that will be taxed at the 15 until you get to the top rate there, and then the excess will be taxed at 25. Now, I know all of those percentages are confusing, but my main point is to indicate that not all of your income is taxed at the rate in which you find yourself in. It's actually graduated up to that.
Yeah, so definitely there's a progressive tax rate or tax bracket structure. And so I'll just throw in the middle of this, if you do happen to be in the 10 or 15% bracket, for example, dividend-paying stocks can really be your friend because you can get those dividends and not pay any tax on them. Oh, and just by the way, if you do have questions, we'll make sure to cover any additional questions here at the end. And so we're going to try and keep track of the time so that we have a good available amount of time for that.
Thanks.
Yeah. So let's see the next area of the we're at the exemptions and deductions slide, and so we're just talking about how exemptions can get phased out, and then for the deductions, there's a standard deduction and an itemized deduction. You get either one or the other. So basically, if you don't have enough itemized deductions, you would get the standard deduction. And there's no phase out for that. For 2014, the standard deduction is $12,400 for married filing jointly, and for singles, it's $6,200. And so just keep in mind in terms of if you're saving all of your receipts for itemized deductions that you've got to have more than those thresholds for it to be worthwhile.
And one of the tax planning ideas, we get the question a lot about whether it's better to file married filing separately or married filing jointly. As it relates to the exemption and deduction, it's important to note that while we provide that kind of planning to kind of give you an idea of which one is more favorable, it is important to note that when it comes to itemized versus standard, if you choose to file married filing separately, both parties have to file the same way. So in other words, if you file married filing separately and one party decides to use standard deduction, then the other party has to use standard deduction as well.
Okay, so we're going to go to the next slide here on labeled business owners and repair regulations, and this is new for this year, and it's there's some new capitalization rules out there, which is going to cause a little bit of stress for anybody that has a lot of supplies or repair expenses, because it's really lowering the threshold. Is there something there, Heidi, that I need to?
I'm trying to think. Is somebody asking a question?
Can you hear me?
Yes.
I'm sorry. I thought I was on mute.
Oh, no problem. Okay, so the repair regulations, it's just important to know that that's out there, and if you do take a lot of expenses normally for repairs and maintenance or supplies, we would really encourage you to work with a tax professional on that, as you may be limited in some of those deductions. For example, materials and supplies. For supply items, let's just use an example like paper clips. You may be limited to deducting up to $200 on your 2014 return, where maybe you bought, I don't know, thousands of paper clips before, and there was no limit on that. And then for something called de minimis purchases, you can deduct the cost of property you purchase if you pay less than $500 per invoice or per item. So there's just these some of these items to keep in mind, as this is a new standard that came through that's effective for 2014. Let's see. The next slide we have is talking about estate and gift taxes, and this is one of those items that did get passed from on a permanent perspective from the Affordable Care Act, or the American Taxpayer Relief Act, which brought clarity to the estate gift taxes. One thing is that now the maximum estate tax rate is 40%, and then the per person amount that's exempt from estate and gift taxes is $5,340,000, and that gets adjusted up every year to basically based on some of inflation calculation. And the IRS has also combined the lifetime exemption for both the estate and gift taxes. So there is a connection between the two, and that's useful now because it had an opportunity at the beginning of 2013 where that was going to possibly go away and get reduced back down to the original levels that was hovering around $1 million. And so the fact that it got moved up to $5,340,000, that's been useful for a lot of small business owners that have assets in that category to be exempt from, potentially exempt from estate taxes. Oh, and then also remember that currently for 2014, you can make annual gifts of $14,000 without triggering any gift tax or gift tax return, or cutting into your lifetime exception or exemption. The next area that I'd like to talk about on our next slide is about tax changes that are coming up, and there's the first item we have is to talk about the extenders. There's a number of you remember I was talking about the American Taxpayer Relief Act made permanent some of these extenders. Well, there's still extenders that exist, and there's about 55 extenders that Congress has to decide what to do with, either let it expire or renew them temporarily or renew them permanently. And so one of those examples that I'll use is as it relates to the Section 179 provision. There was a provision, or there was, I'll say was because it hasn't been extended, to be able to depreciate property equipment up to $500,000 a year. Well, that's set to expire and revert back to where you're only going to be able to do a Section 179 deduction of $25,000, and so that was a pretty useful tax planning strategy where you could say, okay, well, if I've got some equipment I need to use, I can plan on taking the full amount as a deduction. Well, until they extend it, that's not the case. Now you're going to have to, unless they extend it, you're going to have to depreciate it over its life. So a piece of equipment might be over 5 years instead of all as a deduction in the current year. Let's see. There's now a limit on IRA rollovers, and what that means is that previously there was no limit to get a check from a IRA and roll it over into another IRA with a financial advisor. Now you're only limited to being able to do one of those a year, and that's not the ones where it's all handled electronic, like directly. Yeah, with the advisor where you don't ever touch the check. That's specifically the ones where you get a check within the 60-day limit. So it's hard to get the word out here to individuals that are maybe in that area where they maybe thought they could do that. This is a new rule, and so hopefully people that have IRAs are getting this information and aren't making that mistake, because that could be a really costly mistake if you had, let's say, two $200,000 IRAs and you took both of them out in check form with the plan of just rolling them over. Well, you could get hit with a $200,000 of income in the current year because of this new rule. And then just everybody, I'm sorry. The third item on here is about health insurance coverage. So now we're all going to have to worry about reporting what our health insurance coverage is coming up. That's going to add some complexity as I think people, since we're not used to that, people are going to be unsure of what they need to provide to show that they had health insurance coverage or be subject to these new penalties, essentially, that the IRS is going to have in place. And one key point is that this year the penalty was pretty small. It was I think it was $95 and 1%, or 1% of your income in 2014. For 2015, it's going to go to $325 or 2% of your income. And that $325 is not for a family, that's for an individual. So it's going to be like per individual or person. Okay, so just again, we just are telling people that you need to be flexible and be aware of these changes, and we try to make the arrangements as best as we can, again, to limit everybody's tax liability here. Our next strategy is the tax cutting strategies, and so we've got that centered around 5 areas: your family, your investments, your business, your retirement, and your estate. So going to the next slide, just to dive right into your family, it's a good point to look at who you can claim as a dependent. When your kids are in that college age area, you need to be cognizant that they can qualify as a dependent, but only up to the age of 24, and then they have to drop off and file on their own, unless perhaps they make just a very small amount of money. Where you can take any qualifying relative as a dependent if you support them and they only make under $3,950. Let's see. The next slide I'd like to talk about is on the education tax breaks that are out there, specifically with the American Opportunity Tax Credit. We just mentioned previously the children that are college-age students. You'll want to be sure to claim them as dependents, and then also get what's called a 1098-T from them to claim the education credits, and those are phased out based on your income potentially, but still you'll want to look into that, because that could be worth up to $2,500 in credits, of which $1,000 can even be refunded. So that's always a great opportunity. And then the next slide is just to talk about investments, just some different things that you need to think about with investments. There's 2 different areas in terms of gain harvesting or loss harvesting. And so if you have capital gain losses that you haven't sold the stock, but they're on, that's what they're going to end up to be if you do sell them, you can try planning that and selling those at the same time that you have other capital gains, so that they can offset. And otherwise, if you only have losses, you're limited to $3,000 a year. It'll roll over and roll forward, but still, if you were to sell and have a $100,000 loss of some investment, you're going to be only stuck with $3,000 losses a year, unless you have maybe some capital gains to offset that. So you'd want to at least try to marry those up. And then as we mentioned with offsetting, if you don't offset them, or if you're just selling stocks that have appreciated, you just have to be aware of this possible Medicare surtax of the 3.8% on net investment income, where if you're over a certain threshold, $200,000 single, $250,000 married filing jointly, then you're going to have this additional tax. So you might want to at least consider if there's some timing opportunities to hold on to either sell your investments and not go over those thresholds. Sell what you can, but not to go over those dollar amounts. Oh, and then there's a couple of opportunities where you could donate perhaps a stock to a qualified charity to avoid paying the capital gain, as long as you donate it directly to them. And then another opportunity around the area of investments is to look at tax-free muni bonds in the state that you live in, and then you get both. You can get both the income from those bonds tax-free on both your federal and state return. So worth looking into. They don't have necessarily the same return as other bonds or investments, but that's because you can get that income tax-free. And depending on where you fall at on a bracket perspective, that could make a significant difference. So, okay, let's talk about your businesses and some different things to consider with the business side of things. There are credits in place for health insurance. There's different things to think about with employee benefits or retirement accounts. Just to see if you want to have those in place. If it's a small business, even just for yourself to take advantage of those as deductions. I'm going to jump from that into talking about your business structure, where you can look at what's the most beneficial business structure. Is it a LLC, or is it a S corporation or a C corporation? The LLC or a partnership or an S corporation, those are flow-through entities, and so your income is going to go directly, your net income is going to go directly from those to your personal return, whereas a C corp, that's going to be that separate entity and it's going to be taxed at its own rate. Now, in that discussion, that takes some tax planning, depending on the size of the business, could make your argument for whether you want to be structured as a C corp or not. As if you have enough income, well, the C corp, the top bracket in the C corp environment is 35%, whereas at the individual rate it's 39.6%. If it's a smaller business where you're not at those top brackets, then yeah, you definitely need to consider the double taxation issue of the fact that if you are a C corp, it's taxed there, and then any income that you take out would be subject to tax on your individual return too. And then in addition to that, there's other benefits that the C corporation can provide more from a more flexible ability than an S corporation in the way of certain small business-owned C corporations where there's either minimal or no employees, where you could have some health benefits to the owner employees that you wouldn't necessarily be able to have in a S corporation or LLC environment. So the business structure is definitely an important consideration in your tax savings plan. We're going to talk about the Affordable Care Act and just how that affects your business at a high level. If you have fewer than 50 workers, then you aren't subject to the Affordable Care Act and the health insurance provisions. But if you have 50 to 99 employees, then you're required to meet those laws at least by January 1st, 2016. And then anybody with 100 or more employees, that coverage is required effective January 1st, 2015. And then, in addition to that, I mentioned that health care or health coverage credit. If you have fewer than 25 employees, you could possibly be eligible for a credit up to 50% of the cost of the premiums you pay. It's subject to some other rules in terms of the average employee wage and back to the calculation of how do you get to that 25 employees. But that's certainly something to look into if you think that it's a possibility. And then there's another change. If you reimburse your employees for health insurance, there's just a change in how you treat that now, where you have to include that as part of their wages, as opposed to before it was possible to just make that reimbursement and include it in your health insurance expense without including it in the W-2. So that's something that small employers or any employer needs to be aware of. We're going to move to talking about retirement plans and why retirement plans are good for a business and for employees. Basically, a retirement plan offers the ability to defer taxes to the future and give you a current tax deduction. And, you know, basically if your company is, or your activities now are at the higher levels of the income tax brackets, you definitely should strongly consider putting that money into a retirement plan, or maybe you should just consider it anyhow, just so that you can have your own retirement plan and not plan on your sole future income being Social Security, as we are certainly seeing trends don't look good for Social Security. I'm sure it'll be around, but we don't know what fashion or form it will be in the future. And then you could also there could be some tax credits for starting a plan, or you have some individuals that may be able to get a credit on their individual tax return for contributing to the plan. So definitely some good reasons to have a retirement plan. This next slide we're going to just touch on real briefly, passive business activities. There's some considerations there in terms of grouping passive activities to make them non-passive, and just knowing that there's some limitations on passive activities in terms of deducting losses. So if you have any passive activities, we would, again, encourage you to talk to a tax professional on the best way to treat those or plan for those in the current and going forward. Talking about retirement, we just talked about retirement plans, but when you do get to retirement age, you want to try and manage that income to limit your tax liability. We see from time to time individuals that don't necessarily plan it out and get hit with some tax consequences for that. You saved all this money all your life, but then you get to a certain age where you have to take out distributions and you can't keep it in the plan anymore. So you want to try and arrange the withdrawals to maximize your cash flow, minimize your taxes, and avoid any penalties. On our next slide here, our first point is tax-efficient retirement withdrawals. You want to keep your retirement paycheck tax efficient, essentially meaning that you want to assess the accounts that you have, and you might have traditional IRA as well as Roth IRAs, and you want to make sure you know what those mandatory deadlines are for taking distributions. So yeah, I mentioned 70.5 as an age that you have to start taking those distributions, but you could also defer that first distribution to the following year. Now, is that smart? You know, it depends on that person's situation. And then if you don't take your required minimum distributions, you could be subject to 50% of what that distribution should have been, which that's kind of ludicrous. That's more than the highest top tax bracket. So you just need to look at that initial distribution and plan that out. And then in terms of talking some more of the traditional Roth IRAs and Roth conversions, the traditional IRAs have been around for a long time, and you want to be sure you know if you had any non-deductible contributions to a traditional IRA that would have some tracking issues to it. With the Roth IRAs, those are certainly more favorable. They don't have a mandatory distribution, and as long as you've had them for 5 years, anything that you have put into it comes out tax-free. So that can be a pretty useful tool in terms of, again, trying to manage your cash flows that you need. And then the Roth conversion, just knowing the drawbacks if you were to choose to do a conversion. Basically, the first one is that you're paying the tax now for any conversions you do, and that could affect if you do a conversion, that will affect your net investment income, going back to that 3.8% Medicare net investment income tax. You'd want to try and avoid that and do partial conversions if you were interested in doing Roth conversions. And then, of course, you're gonna lose some money because you paid the tax then, so your account will go down in value, but then any future gains would be coming out tax-free. Okay, I'm going to talk about estate planning real briefly, and that is basically, there's just a couple comments there. The first, again, you've got that $5,340,000 lifetime exemption. If you do have a large estate, you'll definitely want to talk to an attorney and a tax professional to figure out what's the best way to potentially distribute some of that before a person passes away, because the estate taxes are really high. Again, that maximum was 40%, but it ratchets up. Estate tax bracket goes up really, really quick when you are paying estate taxes. So you really don't want something going through that area if you can plan it out. We talked about the $14,000 gifting per person per year. That's a big benefit, and then maybe there's opportunities to pay a little bit of tax on some gifts just to get them out of the estate. We can't go into too much detail on that area. It's definitely a complex planning area. The next slide about beneficiaries, it's just a comment with any of your financial assets to keep your beneficiary forms current, so that in that advent of planning, future planning, having those beneficiary forms will allow individuals to acquire those assets without a lot of legal costs, and it'll go to the person that you've directed it to. But as a warning, we've also seen the opposite, where people haven't kept up on their beneficiary forms. We see it almost every year. Hear about it from an attorney that we work with, where somebody didn't update their beneficiary form, and then all of a sudden, they were married and divorced, and then remarried, and then you hear the stories where then the retirement plan goes to the ex-spouse because of the beneficiary form. Mm-hmm. Let's see. On our conclusion slide, before we touch on some of the specific questions, is just to make sure to talk with your accountant to update your tax plan on a regular, I'd say either on an annual basis or some kind of regular basis, maybe every other year or something, if you're not talking about it every year, and individualize it. Not everything that we've talked about makes sense for every person or every situation. We talked about business formation. That's very much individual or tailored plan, depending on the cycle of revenues or income that a business has. And then you want to be clear on what you expect, what's your goal of your plan. I mean, you've got to kind of balance and marry retirement plan contributions and future tax-free dollars with current cash flow needs. But make sure to keep that long-term view in mind. And for example, before buying a business or an investment, think realistically about what the outcomes are that you expect from them while you own them, and seek advice before you make that decision and not after you make the decision. And then, of course, just be sure to be aware that there's change. Something that sounds like a great plan right now could be terrible in a couple of years, or the next time Congress does something significant to the tax code. So you've always got to, at least, and then back to that tax plan, be persistent and asking a tax professional of what's going on this year that you need to be aware of. I'm going to go backwards now and just go ahead and address the specific question that we had from one of our callers on the home office. And I'll just start out with a base overview that you now currently have two options when claiming a home office. Well, no, I'm going to go back even before we talk about that, is do you qualify to have a home office deduction? And even if you do, should you claim that home office deduction? Well, if you're a small business, even if you have a small business, it's not necessarily a slam dunk. And what I mean by that is if you have a separate business location, then you have some limitations on whether you should consider taking a home office deduction. So if you have that separate business location, you could take a home office deduction, but the rules read that you should only take that if you do all of your, you could take it if you do all of your management administrative activities at your home office, separate from the business office. So, for example, if I'm I'll make something up, let's say a construction company, and your business office is just, it's a location, but you don't really do any of your paperwork there. You do all of your paperwork at home, you do all of your billing at home, so then you qualify for that home office deduction for that space you have set aside. Another situation would be like a W-2 employee, and I don't know that we have any W-2 employees on the conference call, but in that situation, it's also pretty tricky. If you have a space set aside by your employer at their work, then you're only supposed to claim a home office deduction if it's for the convenience of your employer. And what does that mean? Well, maybe you're a salesperson for that employer and you're on the road so much, it's like, well, it's just convenient to have a home office to manage your activities, regardless of there's a spot for you at the office. So this could be some areas that you'd want to talk with the tax professional to make sure that your situation makes sense. And then in terms of taking the home office deduction, once you've passed the test of being able to take it, then usually, I usually don't have any reservations about it. It's just a matter of having. Oh yeah, that's a good point. Greg threw in that space should be exclusive and regularly used for that business activity. So your kitchen table isn't going to work. Your living room sofa is not going to work. You could have like a corner of your kitchen where you have a little computer desk set up aside, but that's not going to be very much space, and it's probably not very worthwhile, but you could do it. More often than not, we have individuals that will set aside a bedroom that's exclusive for business use, and you wouldn't want to take a picture of it with your elliptical machine in there as your home office. But yeah, again, a separate space. And then there's other things that you can do, like you can have space set aside for storage, for supplies, and there's common area use that could potentially be pulled in. So there's definitely some different advantages that you can think of to get that home office space. We have people that convert their basement or their garage into offices, that type of thing. But then the two things you can do is you can take either your actual expenses, allocated expenses of utilities and repairs and utilities, repairs, homeowners insurance, real estate tax, mortgage interest, or you could also do what's called now a simplified method. So if you really just want to make it simple on yourself, you can say, well, I'm just going to use that method, which is, I think it's like $5 a square foot.
Up to 300.
Yeah, up to 300 square feet. So that can make things easier on you to just use the simplified method. So that's, in a nutshell, some of the comments on the home office. Now, we have used up about 50 minutes here, so I'd like to see if there's any additional questions that we could answer for you, and we'd love to spend the rest of our time doing that. Otherwise, that's our 2014 tax planning update to get your mind thinking about, okay, well, there's some useful nuggets I need to dive into deeper.
Mm-hmm.
Follow-up question. Hello?
Yes.
Oh, I took
You're
it off
good.
mute. Follow-up question to the home office deduction. I have two questions. One is that I'm aware that it's supposed to be separate, but on one side of the room is my desk and the other side of the room is my art supplies. So do I cut the room in half?
Well, and
how technical can you get with this?
yeah, well, in that situation, when you say the other half is your art supplies, is that art supplies for your business?
No. Yeah, I question just how technical you got to get.
Yeah, well, I mean, basically, you know, I approach things as far as, well, what's the IRS going to ask? And I think they would, you know, if you were to present to them that you have a home office and half of it is for your desk or 3/4 of it is your desk and your computer, but you've got some personal use supplies along the side of the room, they would probably say, well, we would disallow that. But I mean, is that a huge issue if you're talking about a 10 by 12 room that you've got?
Yeah, well, that's it exactly, because it's 300 square feet, and I've been taking it as a 12% cost of all my costs. But really, technically, it's probably 6%.
Oh, because you've got half of it. Well, you know, I think if you got that much space, like half of the bedroom is literally filled up with personal use, then I'd say, yeah, I mean, you have a small risk that if upon audit, if you don't have your documentation set up right, that they could reject your claim. But I think, is it, you know, how much is it worth it to take that deduction then too? You know, is it I don't think that having a home office does raise your risk of having an audit, but it's you know, we've got many people that do claim a home office, so it's also a bounds of like, well, how much is that home office deduction? We mentioned the 300 square feet. That's the IRS has just laid out, okay, there's the simplified method, so if your home office deduction is 300 square feet and it's $1,500, to me what that tells me is that they're likely to look at deductions that exceed that more than deductions that are less than that.
Okay, well, a follow-up question is why I'm worried about it is because I have other income that I'm protecting, or supposedly, and I haven't really tried till recent years to make it profitable. So then I start worrying about, are they going to come back at me as a hobbyist rather than a business owner?
Yeah, well, there, if you don't have income, then you have some limitations on what you can deduct on that home office. So I don't know if you're preparing the return yourself or if you're having somebody else prepare it, but you know, you'd really have to be careful on taking any deduction on the home office.
You would be limited to the income, the profit from the business.
So if there is no profit, then I'm raising flags.
Yeah, if you're taking a home office deduction, yeah. I mean, you can prepare this sheet, and there's a way you do it where you have carryovers for home office expenses that aren't deductible in the current year, but you can't use a home office deduction to make your if your business has a loss, like if it's a Schedule C business type of deal.
Okay, thank you.
Yeah. Is there any other questions, or is there anything else that might be of interest to somebody for us to expound on from our discussion?
Yes, this is Colleen Rickard with CPAP Easy Clean, and we just started our business within the last year, and we took some of our own personal assets to purchase equipment like table saws and different things like this to use for making our products. I know that all that is deductible, but then to be able to show, how do I show that income, came from our personal assets, not from sales?
Sure.
Sales. Do I deduct that out, or how do I do that?
You mean money that you put into your business?
Correct.
Or equipment that you put into the business?
Well, we took and we took and had funds, and we purchased equipment to put into the business.
Okay. So, in a set of books, there's a way that you post it so that you debit your assets and you credit owner contributions, and owner contributions aren't like you said, it's not sales, it's not income. So that's
Correct.
the way that you would book the accounting entry, and then on the tax returns it'd just be simply, not including it as income and just making sure to include the assets. Now there's a certain special way that you do that where you show assets on tax forms, new assets on tax forms on a particular depreciation schedule, and then in addition where you show that deduction, if they're sizable assets, right, like let's say a table saw for over $500 or more, then you'd show it. And I was talking about that Section 179 deduction. I mentioned that a couple of times. You do a Section 179 deduction for those pieces of equipment.
Well, some of it we haven't paid taxes on, but yet we still purchased the equipment. We were able to, not have to pay taxes on it when we purchased the items.
Okay. Well, yeah, I guess I don't know what you mean when you say you haven't been able to. You didn't pay taxes on, like you didn't pay sales tax?
Okay. We didn't pay sales tax. I apologize.
Oh, okay. Well, and so if you didn't pay sales tax on an item, like if you bought it on the internet, that is kind of a different discussion, and unfortunately, that's part of the complication of the tax world is that there's sales tax, estate tax, gift tax, income tax, occupation tax, property tax, way too many taxes. But to your point. To your point on sales taxes, if you buy anything and don't pay sales tax on it, the government, the states, will generally have a form to report that as use tax, whether it's on your individual return for personal purchases or on a business use tax return. The state of Nebraska has a use tax return, and so that's the consideration that you have to make is to filling out a use tax form perhaps for that. And
because we were told that since we're a new business, that we could not have to pay sales tax up to $10,000 within a 3-year period to be able to purchase equipment. It could not go towards an automobile, but the equipment that we needed to start our office and different items like that we could not have to pay sales tax on.
Yeah, that sounds like kind of a weird combination of advice. Like there is a deduction for startup expenses, but that applies to income taxes. And then again, for what you described, buying equipment, you'd be able to do a Section 179 deduction on it anyhow. The exemption from sales tax, I have not come across that. That is not something that I would rely on as an exemption from sales tax for startup businesses. The only exemptions from sales tax are specific to industry. I guess a good example is new construction is exempt from sales tax. But then there's things like repair, like furniture repair is not exempt from sales tax. There's some weird different things that are exempt from sales tax. Another one would be like you go to the grocery store and you buy food, that's exempt from sales tax. But one that's specific to startup businesses, no, I don't think Nebraska has that exemption.
Okay. My other question is, we sell off the internet, and we took and just sold one of our items to a person in London. As far as taxes for over there, how do I even begin to figure something like that?
Sorry, it's hard to hear what you asked. You sold something online.
Online to.
And you sell it to another state, or was it somebody
over in London? In London.
In London. Okay. I don't do a whole lot of international taxes. I don't know what you'd have to do in terms of paying any tax in London, but my initial thought is that generally you don't have to collect or reimburse sales taxes in the United States if you don't have something called nexus in that state that you are selling it to. Generally. So if you are selling something in London, there certainly might be some special rules as it comes to like customs or some taxes that would have to be remitted to London.
Because I wasn't for sure. We sell it on our site, and then it goes through PayPal, and so it was done before I even knew what was going on.
Sure.
But I did not know if we should inform them, that we have to collect X amount of dollars. I put in a call to our tax person, but unfortunately she hasn't called me back yet today.
Yeah, I'd have to tell you, for selling something internationally, we haven't provided a whole lot of advice on international sales, so I don't know what rules you'd follow for that.
All right. Well, thank you very much for the info.
Yeah.
Well, Heidi, it looks like we've come up to the end of our time here.
I think so. Thank you so much for presenting today, and we'll be putting this handout will be up online, and if people request the recording, we'll probably send it out to participants. So if you want to listen through it again, if there's something you didn't quite catch the first time, we'll be sending that out. We do have another Third Thursday training coming up for November. That one is going to be on marketing. So if you are interested in learning more about marketing your products or services, you can join us for free on November 20th. And that sign-up is on the Rotator on GROWNebraska.org. So does anybody else have any other questions? All right. Well, I think we'll call it good. Thank you so much, Brad, for putting this together and presenting for us.
You're welcome.
Thank you.
Thank you, Heidi.
Everybody have a great day.